Assalamualaikum warahmatullahi wabarakatuh, everyone. Okay, so now we will continue with a new topic, which is on capital structure, basic concept. So this is the capital structure outline. So we will cover, right, capital structure policy that will include traditional view to capital structure, and then we will go to the propositions of Modigliani and Miller in two different situations. That the first one in the world of no taxes, and the second one will be in the world of with taxes. And then we will continue with the second part of the capital structure, which is the high gearing problems and packing order theory. Okay, so in the first part, we will go to the situations of a world without taxes. Okay, so as the introduction, all right, we will go to this part first before we go to the Modigliani Miller's propositions, that are proposition 1 and proposition 2. Okay, so the introduction here, just want you to know that and bear in your mind from now onwards that the value of the firm will be represented by V, right? And then market value of equity will be represented by S, and then market value of debts will be represented by B. Okay, so here, right, under capital structure, our concern here, one of the main concern is the value of the firm. So what is the value of the firm? So value of the firm is the sum of the value of the financial claims, okay, of the firm. Okay, and then the value of the firm can be calculated as follows, which is V equals to B plus S. Okay, so what is B and S? B is for debts, S is for equity. Alright, and then the goal of the management of the firm is to make sure that the firm's value is maximized. Okay. Right, there are two important questions that the company should address here, or that we should address here under this part, which is the first one, okay, why should the stockholders care about maximizing firm's value? Why the firm's value maximization is so important to the stockholders? And the second one, what is the ratio of debts to equity that will maximize the shareholders' wealth? So in addressing the first question, we will go to the example here, okay, to answer why the shareholders or the stockholders care about maximizing the firm's value. So this is a Surya company, okay, Surya company, which is currently has a market value of 1,000 ringgit. So Surya company is an all equity firm, right? So that means Surya company is entirely financed by equity, and that equity, right, is contributed by 100,000 shares outstanding, and the price of the shares is 10 ringgit. So that is why, okay, the value of Surya company equals to 1,000, right? So since it is an all equity firm, that means B will be 0, and S will be the market value of the equity, that is the number of shares, okay, issued multiplied by the share price of the share, okay, all right, or share price per unit. So that means V equals to 0 plus 100 shares multiplied by 10 ringgit. So therefore it equals to 1,000 ringgit. Okay, so where this contributed by shares outstanding. Okay, right, so let me show the explanation on here. Okay, so currently, right, Okay, Surya is financed by equity only. So that means the value of equity is 1,000 ringgit and value of debts is 0. So we know that the value of Surya will equals to 1,000. So this one comes from B plus S. Okay, later the company, Surya Company's management propose, right, the capital restructuring. So propose the capital restructuring. How is it? Right, the management plans to borrow. Okay, company plans to borrow 500 ringgit. Okay, and this 500 ringgit is used for dividend payment. Okay, dividend payment to the equity holders. So that is the purpose of borrowing. So the question here is, right, we want to know, okay, what is the impact of this capital restructuring on the firm's value, all right, and also what is the impact of this capital restructuring to the equity holders' income. Okay, so now we assume that from this capital restructuring, there are three possible outcomes. Okay, there are three possible outcomes. Okay, that is the first one. It is expected that the firm's value, okay, the firm's value will increase by 250 ringgit. And another one, the firm's value is expected to decline by 250 ringgit as well. And another one is the firm's value is expected to be unchanged. So that means it will be equal to the current firm's value. Okay, so that means, okay, this 1,000 ringgit, it is expected that after the capital restructuring, the firm's value will equals to 1,250, or it is also expected that the firm's value may be unchanged, which is will equals to 1,000 ringgit as before, or maybe the firm's value is going to decline by 250. So the firm's value is expected to be 750 because it is assumed or expected will decline by 250 ringgit. Okay, now, so this B comes from B plus S, and we knew already under capital restructuring, the companies borrow 500 ringgit. So that means the B equals to 500 ringgit, right? And then here also 500 ringgit, all right? All right. So the question here is, what will happen to the value of equity? The first one just now, the question is what is the impact on of this capital restructuring on the firm's value? It is expected that the firm's value will increase or decrease or unchanged. So three possible outcome. And then the second one, we want to see what is the impact, okay, on the shareholders' income. If the firm's value increase, or if the firm's value decrease, or if the firm's value unchanged. So we want to see the next impact, which is on the equities value and also equity holders income. Okay, now since we know that the firm's value equals to 1250, the B equals to 500, so make use of this formula. Therefore, the value of equity will equals to 750 ringgit. Okay, and then here if the firm's value unchanged, that means the equity value is going to be 500 ringgit because B plus S equals to V. Jadi 1000 minus 500, so S will equal 500. And again here, if the firm's value is expected to decline by 250 becomes 750, therefore value of equity will be 750 minus 500 equals to 250. Okay, so that is the value of equities. Okay, after capital restructuring. Now we want to see what happened to the net income, okay, of the equity holders. Okay, so now, so what income that the equity holders will receive? So definitely, as mentioned in the capital restructuring here, this 500 ringgit, the borrowed cash here, will be used to pay dividend to the equity holders, right? So therefore, the equity holders will receive 500 ringgit dividend. So the dividend will receive amounting 500 ringgit after the capital restructuring. Okay, next, the other one is what is the effects on equity, right? So now we want to see, is there any capital gain, all right, or capital loss after restructuring? So what happened to the value of the equity after capital restructuring? So before that, the firm's the equity value is 1,000, and after restructuring, if the firm's value increased by 250, right, or increase to 1,250, and value of equity becomes 750 only, right? Previously, equity's value 1,000. That means there is a capital loss of 250. Okay. Okay. 250. Okay. Right. And then what about if the firm's value unchanged, remain the same, right? If it's remained the same at 1,000 ringgit, and then value of equity becomes 500. So previously it was 1,000, now it becomes 500. Therefore, another capital gains here of 500 ringgit, because 1,000 compared to the latest or the revised equity value of 500. Okay. Okay, and then if the firm's value decline, so what happened to the equities value? It become much lower, which is previously 1,000 ringgit. Now it's only valued at 250. So therefore, the capital loss becomes bigger if the firm's value decline. Okay, the amount is 750. So here you can see what is the net payoff, right? The net income to the equity holders then. So here, if the firm's value increase from 1,000, right? Increase from 1,000 to 1,250, the equity holders will get the income of 250. Okay, if the firm's value remain the same, 1,000, okay, then the equities holders income will be 0 here. So that means will be at the break-even point. Okay, no gain, no loss. But what happened if the firm's value decline from 1,000, it declines to 750? The net income here is loss of 250. Right? So here we come to the conclusion, right, that the firm's value give maximization, right, is very important to the equity holders. Why is that? Because the higher the firm's value, right, the income to the stockholders will be maximum or will be maximized. Okay, so that's why the equity holders care about maximizing the firm's value. So you can see clearly that if the firm's value decline from 1,000 ringgit to 750, the stockholders or the equity holders incur loss of 250. So that's why the equity holders must make sure that the management of the company, okay, have a capability to maximize the firm's value or to increase the firm's value, because it's very important for their income. Okay, right. The second question is about ratio. What is the ratio of debt to equity that maximizing the shareholders' value? In other words, what is the combination, right? The best combinations of debts and equity, okay, in the capital structure of the company, and that capital structure is maximizing the shareholders' wealth. So to answer this question, we will look at the other example, okay, which is this one. Okay, so before we go to this example, the second example, right? So this is the explanation, right? Now we go to the second part, which is right. So now to answer question 2. Now let us consider an all-equity firm proposes to issue debt to buy back some of its equity. So currently, the company is entirely financed by equity. So you can see here, the debt's value here is 0. Right, so debts is actually represented by B, equity is represented by S. So the value of equity is 8 million ringgit. So where this 8 million ringgit comes from? So this 8 million ringgit comes from 400,000 shares multiplied by the share price of this company, which is 20 ringgit. So this one is the market value of equity. So that's why if we determine the firm's value of this company, B plus S, okay, so B equals to 0, S equals to what? 400 multiplied by, okay, 400K multiplied by 20 ringgit. So here 0 plus 8 million ringgit. Okay, so therefore firm's value becomes 8 million ringgit. Okay, right. And then the company propose, okay, to what is it? To borrow 4 million ringgit. Right. So here, this 4 million ringgit will be used to buy back the shares. So that is the plan, lah. Okay, the plan of this company to buy back the shares from the existing company. So what will happen to the shares outstanding then if the company buy back its own shares from the existing shareholders? So the shares outstanding will be reduced, right, from 400,000 units to 200,000 units, right, and the price is 20 ringgit. Okay, the share price of these shares is still 20 ringgit. So therefore, when we want to calculate the market value of equity, so 200,000 shares multiplied by 20 ringgit. So therefore, value of equity is 4 million ringgit. So that's why this one, right, is shown as here. Okay, 4 million. So you borrow 4 million and then your outstanding shares now becomes 200,000 units only at the same price of 20 ringgit. So it becomes 4 million. So therefore, after restructuring, right, after capital restructuring, the firm's value now, KB plus S, is shown as follow. So B now is 4 million ringgit and S now 4 million ringgit. It's no longer 8 million. So the value is still 8 million ringgit. Okay, in this case. All right. Now we want to see what is the implication of this proposal, all right, of this proposal on the return to the stockholders here. So that's why our focus at this point of time is on earning per share and also return on equities. Okay, so we focus on these two things, right, to show the impact of debts, okay, um, in this company. Okay, now, so we look at this slide, okay, this one. Okay, you can see that this is the current situation, the first column, right, and then after restructuring, right, the company borrow 4 million and then the interest rate is 10%. That means the interest payable is 10% multiplied by 4 million's borrowed amount. Therefore, interest payable will be 400,000 ringgit. Okay, now we want to see the impact on EPS and ROE. Okay, now let's assume that there are three possible economic conditions that we are take into consideration here. Okay, for the first part, in the world of no debts, that means when your debt is zero. So that means the company is unlevered company, no leverage. So how much, okay, so how much the earnings during recession. So we expect that there are three situations here. Economic conditions going to be recession, expansion, and also expected. Okay, so if the economic is in a recession period, so we expect that the earning, the EBIT, earning before interest and tax equals to 400,000, and the normal time 1.2 million ringgit, and expansion time becomes more, which is 2 million ringgit. Okay, so the earning per share equals to, this is the formula, right? Total earning during recession is 400k. You divide by number of shares outstanding during this time, which is the number of shares outstanding is 400,000 shares, right? This one, okay, before restructuring. So therefore, 400 divided by 400k, and then you will get 1 ringgit. So this is what we are going to pay to the equity holders during recession. So the equity holders, if the economic condition is normal, so earning per share to the equity holders going to be 3 ringgit, right? And during expansion is going to be 5 ringgit. Okay, what about return on equity in percentage? Okay, how is it to calculate? So it is earning after interest. So since we are not financed by debts, because there is no leverage, no debt, so no interest payable. So that means this earning is what? Entirely distributed to the equity holders. Okay, right? Entirely distributed to equity holders. That means 400,000 ringgit. Right? Divide by total equity. That means equity value. What is the equity value? Equity value is 8 million ringgit. Okay, which is 400,000 K multiplied by 20 ringgit. Okay, so 400 divided by 4 million, is it? Okay, 400,000 divided by 8, not 4, divided by 8 million ringgit, and then multiply by 100, so you get 5%. Okay, if the economic is normal as expected, the earning is going to be 1.2 million, so that is 1.2 million divided by 8 million ringgit. Okay, 1.2 million divided by 8 million ringgit, so multiply by 100, then you get 15%. Okay, and then for expansion, same formula, right? So the earning is going to be 2 million ringgit. You divide by 8 million ringgit equity value, multiply by 100, then you will get 25%. So that is the ROE and earning per shares for unlevered firm, okay, do in different economic condition. Okay, now after proposal, okay, so after capital restructuring, the company become levered. So what does it mean? The company has debts in its capital structure. Okay, so that means the company become levered, Why is that? Because the company now start having debts in its capital structure of 4 million ringgit. So if the company has debt, that means the company has to pay interest. So how much the interest? The interest is 400,000 ringgit. Why is that? 4 million ringgit the borrowed amount multiplied by 10%. Okay, so if the economic is in a recession period, so the earning is going to be 400,000, then you minus the interest 400, so therefore nothing left for the equity holder, zero amount. So that's why the EPS to the equity holder is going to zero, and also return on equity in percentage also zero. Okay. During normal, the earning is expected to be 1,200,000, and then you have to minus the interest first, and then the balance amount will be paid as dividend or as the equity holders income, correct? Right, so the EPS will be the balance left here, which is 800,000, and then you divide by equity. Sorry, this one number of shares of how many shares outstanding now once the company become level 200. Why it becomes 200 now, not only 400 anymore? Because 200,000 shares already purchased, right, back by the company. So shares issued left now become 200,000 shares. Okay, right, so here 800,000 ringgit, you divide by 200,000 shares, so therefore the EPS become 4 ringgit per share. Okay, and then if the earnings 1.6, why is it? Because 2 million you minus first the interest payment, then it leaves you the amounts of 1.6 million. Okay, and then this 1.6 million will be provided as the EPS to the equity holders amount 8 ringgit. How is it? 1.6 million divided by 200,000 shares. Okay, so the EPS become 8 ringgit now, which is higher than the previous one. Okay, right. What about ROE? Now ROE during normal time, earning after interest 800, you divide by equity's value. What is equity value? Equity value is no longer 8 million, right? Equity values now become 4 million. So therefore, earnings 800 ringgit, 800,000 ringgit, you divide by equity value 4 million ringgit, right? And multiply by 100, then you will get 20%. Okay, right? And then here, right, 20 percent. Now here become 40. Why is that? Because here you will get ROE equals to 1.6 million ringgit. You divide by equity value now is 4 million as well. Okay, 4 million ringgit, no longer 8 million, and multiply by 100%. Therefore, you will get 40%. Okay, so this is the ROE after restructuring. Okay, right. So that is the impact of the capital restructuring on the equity holders. Okay, or equity income. Now, so we want to show in a graph here, in a diagram below. Okay, you can see that this graph shows the relationship between the earning per shares and the total earning of the company. Okay, right. The dotted line, the green line, okay, green dotted line here is the line for EPS for the levered firm. Okay, and the red line here, this is the EPS line for the unlevered firm. Okay, and then please take note that this is the intervention point here, right, which is intersection point, where this is the break-even point, okay, where the EPS for the levered firm and unlevered firm is going to be the same. Okay, EPS for the levered firm and EPS for unlevered firm is the same, which is equals to 2 ringgit. When it happened? When the earnings, the earnings here is 800,000 ringgit. Okay, when the earnings at 800,000 ringgit, the EPS for levered and unlevered are equal. Okay, right. Okay, if the earnings, right, move to the right, so that means during expansion time, okay, you can see that the dotted line stands for what? EPS for levered firm. That means the earning per share, okay, for the levered firm is higher than the earning per share in the unlevered firm. You can see that if it's more than 800,000 ringgit, that is 1.2 million and 2 million. So if the company become levered, the equity holders will receive higher EPS, right? During good time, during EPS. Sorry, during expansion. So the EPS will be higher. That is 4 ringgit and 8 ringgit as compared to the EPS for unlevered firm, it's only 3 ringgit and 5 ringgit. Provided that, what is it? If the economy is expanding. Okay, right. So this here situation here, we can see that the debts is giving benefit to the equity holders. Why is that? Because they can get higher EPS. Okay, right. But what happens if the earnings of the company is moving to the left? That means the economy is facing recession time. Okay, what happened? That means if the earning is lower than 800,000, such as 400,000 ringgit here in this case, so you can see that the EPS in the levered firm, the dotted line here is the line here below. The dotted line is below the red line. So that means what? The EPS in the levered firm is lower than the EPS in the unlevered firm. Unlevered firm, right, can pay you 1 ringgit EPS as compared to the levered firm, 0 ringgit only. Why is that? Because the earnings that they have here, 400,000, must be used to pay the interest first. Okay, and the balance left, okay, will be payable to the equity holders as the income. So here we could say that, right, the leverage is not giving benefit to the debt holders, sorry, to the equity holders. Okay, so if that is the case, right, we can conclude that there is no specific rules or no specific um, condition for determining the best combinations of debts and equity. So we could say that the choice of the combinations of debts and equity is depending on economic conditions. So we can say here, right, the levered firms have better return after break-even point in good times. That means the leverage, right, we could say here, right, leverage give benefits to equity holders in good times. Okay, where they will receive a higher return. Okay, okay, but the leverage will not give benefit to equity holders during bad times. So you can see that during recession, right, the leverage has no good, okay, to the equity holders. Why is that? The return to the equity holders is 0 here as compared to the unlevered firm, which is 1 ringgit, higher than 0, right? So debt is not good to the equity holders during bad time or during recession. Right, that's why we can say here or conclude that there is no specific rules and condition for determining the best combinations of debts and equity. We could say that the choice of choosing the debts and equity amount, okay, is depending on the economic condition. Okay, so here we have answered those two questions, okay, before we go to the Modigliani and Miller proposition. Okay, right. So this is the explanation. Okay, now we go to the next part, the Modigliani and Miller proposition 1 and proposition 2. Okay, right. So to apply the Modigliani and Miller proposition 1 and 2, so we have to use the assumptions in order to explain this theory. Okay, it includes well-diversified investors. That means the investors form a diversified portfolio. And then we assume that the capital market is perfect, where there will be a homogeneous expectation, right, as the investors are assumed to have the same information, right, and they will be acting rationally in making the investment decision, right, and there will be unrestricted borrowing and lending, and lending and borrowing rates will be at the risk-free interest rate and etc. Okay, so you can look into it, okay, later on your own. Okay, now we go to the first proposition, okay, Modigliani and Miller. Okay, the first one, before we go in detail, I need to show you, right, this part. Okay, so now we have started to cover the Modigliani and Miller theory. So Modigliani and Miller propose two propositions. So there are two propositions introduced by Modigliani and Miller, proposition 1 and proposition 2. Okay, proposition 1 and proposition 2. So proposition 1, okay, is actually for explaining firm's value. Alright, to explain the firm's value. Okay, proposition 2, to explain the expected return to equity holders. Okay, right. So firm's value here, we will use V. Okay, and then for expected return to equity holders under Modigliani and Miller, we will use RS. Okay, so traditionally, RS here is actually referring to the ROE, return on equity, the one that we calculate using the traditional formula. Okay, but from now onwards, okay, we are going to use the formula under Modigliani and Miller to calculate the expected returns to the equity holders. Okay, so these two propositions can be applied in two different situations. The first one, it can be applied in the world of no taxes, right? No corporate taxes. And the second one can be applied in the world of with taxes. Right, so there will be different implications under this proposition. Okay, so firstly, we will go to the first situation, that is in the world of no taxes. So we're still talking about Modigliani and Miller, right? But this time we go to the first situation in the world of no taxes or no corporate tax. Okay, and we will apply this situation to the proposition here. Okay, that is the first one, proposition 1, and the second one is proposition 2. So that means in the world of no taxes, right, it relates to the firm's value. Okay, so here under Modigliani and Miller, in the world of no taxes, the value of unlevered firm will equals to the value of the levered firm. That means, right, in this case, the firm's value is unaffected by the leverage. Okay, right. So if we show it in a diagram or in a graph, right, to show the relationship between firm's value and the leverage, that is debt amount. Okay, if the firm's value, the firm has no debt, that means the debt is zero. Okay, let's say the firm's value at this point. Okay, so this is called as VU, no debts, no leverage. So this is the firm's value. Okay, if the company have debts, right, of 2,000 ringgit, so the firm's value is going to be the same at this point. If the firm's value reduce the debts from 2,000 to 1,000, the firm's value is still the same at this point. And if the firms increase the debts or add more debts in the capital structure to 4,000, the firm's value is still the same. So that is why we say here the firm's value is not affected by the leverage. So therefore, it will be a straight line here. So that means this is for VL, VL, VL. Okay, so therefore VU equals to VL. Okay, so no changes in the firm's value. Okay, under Modigliani and Miller proposition 1 in the situations of no taxes. Okay, it will be different if the taxes is or are taken into consideration. Later on, right, I will show it to you. But at this point of time, I want to show you the first situation in the world of no taxes here. Okay, the second one, we want to show you the proposition 2 to show the relationship between what? Expected return to the equity holders. Okay, that is the RS. So what is the implications of the leverage on RS now? Okay, if the company has no debts, that means if the company is unlevered. Okay, for unlevered firm, let's say the RS will be here. So this is the points of RS. Okay, at this point, this is also known as RO. So RO is actually unlevered cost of equity. Okay, so that is RO, and this RO will be equals to RS. Okay, so this can only happen if there is no debts. Okay, RO will equals to RS when there is no debts and no taxes here. Okay, now what happen if the company put some debts in the capital structure, let's say 2,000, right? So what happened, right? So this is for debts exist, this is for RS exist, okay? So what happened if the company put or add debts into the capital structure amounting to 2,000? So that means the companies now become levered. That means the company's risk becomes higher. Once the company has that, so that means the company has created risk, okay, on the investment of the equity holders. In other words, the investments of the equity holders in this particular company become more risky. So in that situation, Okay, that means the return to the stockholders or equity holders will be higher. Okay, to compensate that risk. So therefore, maybe let's say the return to the equity holders become higher than the previous one. Okay, and let's say you put more debt in the capital structure, 4,000 ringgit in the capital structure, and then what happened to the equity holders return? Again, the return will be increased again. Why is that? Because the risk now become higher. Okay, when the company increase or put more debts in the capital structure, so that means the company become more risky, and then the equity holders will receive higher return. Okay, in order to compensate that risk. Okay, so therefore, right, if you draw the or connect the points here, the line will be like this. Okay, so the relationship between the expected return and the leverage is a positive relationship. Okay, there is a positive relationship between return to the equity holders and the leverage. Okay, so the higher the debts, the higher the risk to the equity holders. So therefore, the higher the return. Okay, so that is the second proposition. Okay, right. Let's go back to the slide here. Okay, so this is what I mentioned just now. Okay, under proposition 1 relates to the firm's value. Okay, in the world of no taxes, the value of unlevered firm equals to value of levered firm. All right, the second one, proposition number 2. Okay, proposition number 2, and again, in the world of no taxes, right? It shows that there is a positive relationship between the expected returns on equity and the leverage. So in other words, the higher the leverage, right? The higher the leverage, the higher the RS that is returned to equity holders. Why is that? Because higher debts, that means higher risk to who? To the equity holders. So in order to compensate this risk, so therefore the company will pay higher return. Okay, so this is the formula, right, to determine the RS. Okay, later on I will show you in detail how to measure or to calculate the value of the firm. Okay, under Modigliani and Miller. All right. Okay, the next one, additional point that you need to know is overall cost of capital. Okay, the RWACC. Yeah. Okay, the third one. Okay, so the first one, proposition 1 is about firm's value. Proposition 2 is about return to the equity holders, and the additional point is about, okay, additional point is about overall cost of capital. Okay, overall cost of capital. So we also want to know what is the impact of leverage on overall cost of capital in the world of no taxes. Okay, in the world of no taxes, we also want to see what is the impacts of leverage, that is the impacts of debts on overall cost of capital. So this overall cost of capital we will use RWACC. Okay, so what is the impact? The impact is that if we do the calculation later on, an example, we will see that RWACC will be unaffected by leverage. That means, okay, RWACC in the levered firm, right, will be equals to the RWACC in the unlevered firm. Okay, so that's why it is stated that the RWACC is unaffected by leverage. Okay, so later on you will see clearly. if we do the example. You no need to worry. So this is the example, this is the conclusion for proposition 1 and proposition 2, and at this point of time it is in the world of no taxes. So please bear in your mind. In the world of no taxes, proposition 1, which is relates to firm's value, state that the value of levered firm and unlevered firm's value are equal. Okay, so value of unlevered and value of levereds are equal. And for proposition 2, in the world of no taxes again, right, there is a positive relationship between RS and leverage. Okay, positive relationship between what? Return to the stockholders and leverage debts. Okay. Okay. Right. So that is the first situation. Right. The next one will be in a world with taxes. That means we consider the corporate taxes. Okay. So straight away, I just show you the first and second proposition under situations of with taxes. Okay. So still talking about Modigliani and Miller, but this time with taxes. That means we consider the corporate tax. Okay. So as mentioned earlier, right, there are two propositions, proposition 1 and also proposition 2. And we knew already proposition 1 is for firm's value. Okay, and proposition 2 is for expected return to equity holders. Okay, so previously when we do or we ignore the corporate tax, right, in the world of no taxes, the value of the levered firm and unlevered firms are equal. But this time, right, we cannot say that, right? The value of levered firm and unlevered firms are not equal. Okay, so why is that? Because, okay, the value of levered firm is going to be higher than the value of unlevered firm. So why the value of levered firm is going to be higher as compared to the value of unlevered firm? This is due to tax shield. Okay, due to tax shield, or sometimes it is called as tax saving. Okay, or sometimes it is called as tax reduction. Okay, so this tax saving or tax shield here will increase the firm's value. Okay, so this amount will increase the firm's value. That makes the value of levered firm becomes higher than the value of unlevered firm. Understand? So that means if we draw a graph to show the relationship between firm's value and debts, right? So you can see that here. So vertical is for value of the firm, horizontal for debts amount or leverage. So here is 0. So previously, when there is no taxes, the firm's value for levered and unlevered are equal, right? So it will be a straight line, correct? Okay, but this time we consider tax. So if that is the case, this one in cases of no taxes. But here now we are considering the corporate taxes. So what happened? So if there is no debt, there will be no tax saving because you are not paying any interest, right? So that means you are not getting any tax saving or tax reduction. Okay, so let's say this is the value of another firm. So let's say you add debts, you put debts or leverage in the capital structure amounting to the debts amount to 1,000 ringgit. So here you have to pay interest, right? And this interest will be treated as an expense. And then it will be recorded in the income statement. right, in the income statement, right? So what this interest will do to the taxable income? So here, therefore, the taxable income will be reduced by the amounts of interest, right? Okay. So that's why the company will pay or will have a lower taxable income. So that means taxable income will become smaller. So that's why you can save or you can increase the firm's value. Okay, so look at like this. So this is for view unlevered firm. So now if you have that, so that means the firm's value maybe become this much, right? If you add more debts from 2,000, now debts will become 4,000. So then you get more interest have to be paid, right? You have more interest to pay to the creditors, correct? So when interest become more, therefore the taxable income will be become lower, right? Or less tax to be paid, correct? So when interest increase, that means less tax, okay, payable. So more tax will be saved, okay. So here, let's say the value of the firm become this much. So that tax saving, right, will increase the firm's value. So that's why it becomes higher than before. So if you draw the line, so this is the line for the firm's value of the levered firm. Okay, all right. So the difference here between this line and this line, right? So this is what we call tax saving. So these amounts of tax saving increase the firm's value. So we will look into this point in detail when we are doing example later on. Okay, the next one, we are going to the second proposition, proposition number 2. So again, it's about expected return to the equity holders, RS. All right, so it still have a positive relationship, okay, between the RS and leverage. So that means the higher the debts, the higher the financial risk, right, transferred to the equity holders. Therefore, the higher the return has to be paid to the equity holders. So therefore, again, right, the graph will be, so this is return to the equity holders, right, and then this is the leverage, debt, 0, right, so the RS will be like this. Okay, right, but the difference between the RS in the levered firm, okay, and the RS between RS in the unlevered firm is like this. So this is the RS for unlevered firm. Okay, return to equity holders in the unlevered firm is higher than return to the equity holders in the levered firm. Okay, when the company starts having debt. So let's say debt you 2,000 ringgit here, right? For unlevered firm, the RS will be at this point. Okay, for unlevered firm, but for levered firm, RS will be this point only. Okay, why the RS in the levered firm is lower than RS in unlevered firm? This is because the risk, right, faced by the company due to the debts is reduced or minimized by the tax shield. Because tax shield has made the risk, okay, faced by the equity holders lower. Okay, so it minimizing the financial risk in the levered firm. So that's why RS in the levered firm is lower than RS in unlevered form due to tax shield. Okay, so this one subject to tax shield. That's why it's become a bit lower than the unlevered forms RS. Okay, so that is about the Modigliani and Miller proposition number 1 and number 2. So let's go back to the slide here. Okay, so this is the explanation why the firm's value increase when the company consider tax because of tax shield. So this is an example. Actually, this example is taken from your textbook. So I think you can read on your own. Okay, about this example. So you can refer to page number 209, example 6.3. Okay, you will see what makes the firm's value increases when the company consider taxes. Okay, right. So this is the graph. Okay, this is what I mentioned just now about proposition 2 regarding RS here. So this is RS for unlevered firm. Sorry, for levered firm. Okay, hold on. Let me explain to you again. Go back to this one. So this is not for unlevered firm. This is for levered firm. But for this is RS for unlevered firm. If the company hold on, this is the RS for levered firm, but no tax. Okay, no taxes. This one levered firm. This one, the red one, levered firm but with taxes. Okay, right. So let me write for you this one. Okay, so we can make a conclusion. RS for the levered firm without taxes is higher than RS levered firm, right? And with taxes. So this is because, right, for this one, subjects to tax shield. Okay. Right. Okay, this one. So this one for levered firm. But no taxes. Right. This one for levered firm. But with taxes. So therefore, it subjects to tax shield. So this will reduce the risk. Okay, risk from debts. So that's why the RS in this company a bit lower than the RS in this levered firm without taxes. Okay, maybe you were a bit confused. Later, when we do example, you can see clearly. Hopefully, right? So this one, the conclusion, right, for proposition 1 and 2, but this time with taxes. Okay, right. So for proposition 1, okay, the value of levered firm and value of unlevered firm cannot be equal, right? So you can see the formula here. Right, value of levered is not equals to value of unlevered. Why is that? Value of levered firm becomes higher than value of unlevered. Why is that? Because of the tax shield. So this is the formula for tax shield. Okay, later on we will see in detail. Proposition 2, again, this is about the return to the equity holders. So when the company become levered, right? The equity investment become more risky, and then the return, what? This risk will be offset by the tax shield. So that's why the return for the levered firm in the situation of with taxes becomes smaller than this one or lower than this. Okay, in the world of without taxes. All right. So, but the relationship between the RS and leverage is still positive relationship. Okay, relationship between these two things, variables here, is still positive relationship. Okay, right. So this is a comparison, the summary. Okay, to compare between the proposition 1 and 2 in the world of no taxes and with taxes. Okay, right. In the world of no taxes, the value of the firm is unaffected. So that's why we could say that the value of levered and unlevered equal. Okay, but for the second thing here, okay, in the world of with taxes, okay, the firm's value for levered and unlevered cannot be equal. That means VU is not equals to VL. Why? Because VL always higher than VU. Okay, VL always higher than. Okay, now we go to the next part, which is proposition number 2. Okay, proposition number 2 is about return. Okay, it's about return. All right. States that proposition number 2, in the world of no taxes, the leverage increases the risk and return to the stockholders. Okay. Positive relationship, okay, between RS and leverage. Alright, and here in the world with taxes, okay, proposition number 2, again still about return to the equity holders. Okay, the leverage increases the risk and the return to stockholders. Same here, there is still a positive relationship, okay, between RS and leverage. Right, but due to the tax effects, so this tax effect will create tax shield, all right, and this tax shield will offset the risks from arise from debts. So this will make the RS, okay, in the levered firm with taxes lower than the RS in levered firm in the world of no taxes. I mean RS here on the left hand side is going to be higher than RS on your right hand side. Okay, why is that? Because of this reason. Okay, so that is the reason why RS in the levered firm with taxes is a bit lower or lower than the RS in the levered firm in the world of no taxes. Okay, so that is the summary and the conclusion. Okay, later on I will go through the example with you. Okay, so I'll see you in the next meeting. Thank you.